Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us. Don't forget to like and subscribe and click the bell so you get a notification of when we release a new video. I'm sitting again today with Michael Porter. Hello, Michael.
Morning, Robin.
So, Michael, I know that we probably think we're saying the same things over and over, but we work with it every single day. But Jerome Powell gave a speech, I think, on Wednesday evening, and the markets were very happy with that. So, can you tell us what he said and what happened as a result?
Sure. It was the Federal Reserve meeting for interest rates, and basically the outcome of that, Robin, was that the Fed is still on track to start cutting rates this year, and they were still essentially hinting that June would be takeoff date for rates, and that the Fed is still looking sort of for 3 cuts over the balance of the year.
Yes.
So that's basically what they said. Obviously, if you've been sort of following the news, and you would have seen that oil prices have ticked up in the last couple of weeks, and food prices are ticking up a little bit. I mean, there's some drought, especially in southern Africa here. We're having quite bad drought conditions actually at the moment. But generally speaking, inflation is ticking up a little bit. It's, as opposed to surprising on the downside, it's slightly now it's a couple of basis points above where it was expected to be. And so the market was then starting to adjust its interest rate expectations and say, well, maybe we're not going to get a cut, maybe we're not going to get a cut. And then Powell basically reinforced the message that no, the Fed's on track.
Yes. Okay. So obviously, when in the 10 days leading up to that, the American economy was looking quite strong. Some of these inflation things were coming through, and that makes everyone think that, well, we're not going to have the 3 cuts to the end of the year. So they start to price that into the market, which is why we saw the weakness in so much. And that has a big knock-on effect for us or emerging markets, doesn't it?
Yeah, definitely. I mean, one thing we always say, Robin, is the dollar.
Yes.
The dollar is US interest rates and the dollar are 2 of the sort of key pivotal points in the whole financial system, I suppose. And so, yes, as soon as the Fed came out and said that, the dollar started to weaken. We were at 18.65, 18.70 to the dollar yesterday. We have weakened a little bit overnight, but there's such an ebb and flow in these things. And the other side is then that the commodities start to rally. So the gold price hit a record high on Thursday, $2,210 a barrel. An ounce.
Yeah.
Sorry, barrels of gold would be quite nice.
Yeah, it would be nice. Yeah.
So for those gold bulls out there, I mean, that's a record high. It's retreated a little bit today, but
Yes.
The trend is very firmly in place, and that has a positive spin-off to us. The rand gets a little bit stronger. Our interest rates, there's scope for us to cut, and so the cycle goes. But it's so much is dependent on what happens in America.
Yeah. So from a client point of view, I guess, it's very difficult not to live statement by statement, and so you eagerly open your statement to look at your value and see how it's changed month on month. But Michael, that's not how you, as an asset manager, look in terms of the movements. You're looking a bit further than that, aren't you?
Yeah, Robin, we're looking sort of 18 months down the line, or 2 years, and at what we think is sort of coming, and also just what are good businesses that can weather generally broad cycles.
Yes.
And so yes, I mean, we know that interest rates are going to start falling at some stage, and sometimes the market will look through the current weakness and say, well, in 9 months' time, interest rates are going to start falling, so we're buying this. And other times they'll focus very much on the short term, but we're sort of focusing on, we know interest rates are going to come down. We know, we have a view that the rand is going to be a little bit stronger because of what the dollar's doing. Mm-hmm. And so we start building portfolios now for how we think, conditions are going to be like in 9-12 months' time.
Yes.
But it might not be those conditions in the next 3 weeks or a month.
Yes, One of the things I've noticed, particularly in our sort of reviews when the analysts have been presenting, is you guys have focused a lot on the interest payments by companies on their debt. And it's quite significant to see how a change in interest rates impacts their costs and obviously the bottom line. That's part of what you're watching quite closely, isn't it?
Yeah, definitely, Robin. Interest rates, not in this country necessarily, but globally, interest rates have been low for a long time. Really since the financial crisis in 2008. And American interest rates ticked up in 2017, 2018. But really, we've had 15 years of almost zero interest rates, give or take, and it's been a time where companies have leveraged up a lot. So you've got quite a lot of debt, and now suddenly you're paying interests on all that debt, much higher levels of interest.
Yeah.
And we all know, if you're paying interest, that takes away from your profit, it takes away from, certainly as to your expenses. So definitely as the cycle peaks out and interest rates fall, you'll get that positive right back of less interest equaling slightly higher profits and things like that.
So hopefully looking forward, in 18 months' time, we've got a lot less money going on diesel and a lot less money going on interest, and hopefully that speaks well for profits and increasing dividends, which is really where we're looking at. Michael, thank you for giving us some insight into that. Thank you for joining us. Please don't forget to like and subscribe, and we'll catch you next time. Bye-bye.
Bye.